Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending February 10th, 2023. I'm Preston Brent. Thanks for tuning in. Well, this week's theme is the January run over, buy the dip, or sell the rally? It's going to be on everybody's mind as we got some key information coming up this week. But first, let's just dig in and take a look at where we went last week and then what I'm expecting for this week. So if we look at the week, overall, it was really the first week that we've had a little bit of pushback on the big rally that we've had in the month of January. You can see all the major indexes are down, with the Russell being the most, but they're still year to date up fairly strong. Okay. We didn't have very much important economic data releases out, but we did have statements from Fed officials, as well as Boom Boom Powell doing a Q&A session at the Economics Club in DC, when he basically said that disinflation process has started. So that kind of helped the markets on that day. But then we got Friday jobs payroll, which was through the roof. And markets were a little bit concerned, or that was last week, but markets were concerned as to how Powell, would he change his tone or not? And he really didn't. So as I said, since the October lows, markets are up about 15% over that 4-month period. And yet we've seen the Fed funds rate rise about 1.5% just in that 4-month period. And granted, the rate hikes are slowing down, but they're still on the path to continuing to raise their rates, right? There's an argument that the market rally over the past 4 months has really been in anticipation of the Feds nearing the end of their tightening cycle. But the big market risk so far that I see is the Feds might just keep raising their rates if we see stronger inflation or sticky inflation, which would reduce the forward market valuations and hence move equities much lower. So there's a lot of risk floating around out there. If you look at the best and worst sectors for the week, energy had a good strong week. Worst was communication services. Leading the pack year to date so far is discretionary. It moved just ahead of communication services. And bringing up the rear as last week is utilities at almost 4% to the downside. See the PE ratios, the forward PE is still a very lofty 18.57. I think that's a lot stronger than it should be. You can see the dividend yield is less than the 10-year Treasury. The Treasury moved up a pretty good little bit this week, which moved or the interest rate moved up, which moved the bonds down just a little bit in anticipation of the Feds being a little bit more hawkish than anticipated with that jobs report. You can see the earnings yield is 5.55. The S&P yield over 10-year Treasury still positive. Real yield is still negative. That's due to inflation. And then the current VIX, it moved up for the week a little over 11.5%. to finish out the week at 20.44. We got, after the previous Friday's jobs numbers, we did get University of Michigan consumer sentiment on Friday. It was it moderately exceeded expectations. It's reached the highest level since January 2022. So the consumer seems to be coming back just a little bit. All right. And as I said, the benchmark 10-year Treasury increased pretty good bit for the week. I think it shows that investors are continuing to digest that strong January payroll report. And meanwhile, with that rate moving up like that, the yield curve inverted even more. The 2s over 10. It hasn't been this inverted since the dot-com bubble, over 4 decades, really, even longer than that, 4 decades. So fear is continuing to mount that the Fed's going to need to push the economy into a recession to get some of this sticky inflation down. So we got a lot of information going on right now. I mean, that's kind of what we're seeing. Now, if we move across the pond, take a look at what's going on over there. You can see that, again, over there, everybody was in the red with the exception of Japan. But outside of that, year to date, everybody is still very strong, right? I mean, you can see the Euro stocks is up 10%. That's 50 of the largest companies across Europe. And you can see the FTSE's up, CAC 40's up very solidly in double digits, just like NASDAQ here. Everybody's strong, okay? We did see over there shares in Europe this past week. They're like the U.S., where they're afraid of the aggressive policy of the central banks, the ECB and the Fed here, of course. They're concerned that they're going to be forced to hike the rates a little bit more than expected. Um, so, given the jobs report, the strong monthly jobs numbers on Friday, and given what we're seeing, that's where the fear is, just short-term fear. We did see the volatility gauge move into a backwardation instead of a normal contango term structure on the front month VIX and the front month vol or the VIX and the front month vol futures. The back month, it's still solidly in the green. So there's not a lot of fear going out in time, but there certainly is over the next 30 days. So I'm seeing some of that. Meanwhile, the ECB this past week also reiterated their hawkish stance on the markets as well. And the UK just barely avoided a recession. Their GDP came in right at flat for the last quarter of last year. So they avoided a second consecutive quarter of economic contraction, but still very ugly. I mean, it's not very pretty over there. Although you're getting a lot of people in the markets, it's going to be real interesting to see how this plays itself out, because you've got one side of the table saying that the Feds are going to be forced to pause and that actually start cutting rates in Q4 of this year. And you got another group saying, including the Fed, saying that's not going to be the case. So eventually we're going to sort all this stuff out. Okay. Now, if we go over the Asian markets, you can see, as I said, the Nikkei was the only one in the green for the week, right? Everybody's solidly in the green year to date, but Nikkei was solidly in the green for the week. Prime Minister Kishida is looking to appoint a new Bank of Japan governor, and the rumors came out after Friday that he's going to appoint Kazu Uda. And his previous comments suggest he's a very balanced tone, calm type individual, which is what the market's like, and also the importance of reaching 2% sustainable inflation. So that kind of calmed the markets in Japan and gave them a little bit of a bump for the week, although just barely, as you can see. Meanwhile, in China, their CPI picked up a little bit in January from a year ago, but they're just now opening up, all right? And as I've told our members, it's going to take a while for China's consumers to get out and about. If you look at how it happened here in the U.S., it took about an extra 3 or 4 months before consumers were really out there spending. Most of them, they kind of stayed in their hobble for a while. So the other thing that happened is obviously we got balloon gates. So Chinese stocks kind of retreated a little bit on that, with possible tensions between the U.S. And how are they going to respond to that? So Chinese stocks pull back just a little bit. Okay. So we got a lot of activity going on. Now, let me just quickly go over some of the charts with you. Let me just swing this over. And let's get it over here like this. We're going to go to the E-mini S&P 500 futures. And let's just get that up on the screen here. Where is that? Right here. Let's put that on here like this. So you're going to see here that since our high for this year on the 2nd of February, we've just been slowly pulling back. I mean, we were up a little over 6% intraday. But really the tough line in the sand is that fib node 0.236, as you can see, is a daily chart. We spent about a week here trying to get over it. We failed, and now we're down at this level here. Notice we did get across in the 50 and the 200 EMA. So that turns the algos more into a buy the dip kind of mode, at least on the S&P. All right, and you could see here on this dip, we came down, and even though the 50 was below the 200, it tested the 50, came back over the 200, testing it several times, and then it cleared this shaded zone, which was our R1 level, our first level of resistance. We cleared it, and that was a kind of an all clear signal to stay long for another week or so. Now, on this big move here, as I told our members, especially for the tech sector, you want to fade the move, okay? Technology hadn't had this big of a move to start at January since the dot-com bubble. So I just think that it's going to settle back down, and this week is going to be a very big week because we get CPI data on Tuesday. That's the consumer inflation at the consumer level, and then you go with the PPI data on Thursday. That's the wholesale level. So these inflation reports, as I've also told our members, can move the markets a good deal. I mean, a good deal. We've had on average over a standard and a half, 1.5 standard deviation move in the S&P on the past 5 CPI reports that come out. So it's going to be interesting this week how this stuff shapes up and where we move. Downside support is obviously going to be at the 50, which is right in the middle of my shaded zone there. It's sitting right around 4,000. Now we're sitting at 40.99 where we closed. That's only about 100 points south of where we are. And believe me, it could do it in a day, right? On just a big down move. I don't think that will happen, but that'll be our support. And then, of course, if we look at NASDAQ and just take a look at the NASDAQ 100, let me just find this here. I know it's on here somewhere. But here we go, right here. NASDAQ 100 down about 83 points. You can see also on February 2nd, it was up intraday 17%. Now, keep in mind, NASDAQ 100, about 40% of that index value are the FANG, right? And if we look at the Fang Index, because I've customized an index that's just Fang, I don't have Netflix included, but I do have Microsoft, Meta, Apple, Google, and Amazon in here. And you can see it's come down as I said it would, and it filled that gap. That gap was at 1301. You can see it came down. It's resting right on or just slightly below the 200 EMA. I knew it would fill that gap. I mean, it was just itching to fill. So, and that's what's moved the NASDAQ 100 futures down a pretty good bill. You could see they were still up nicely for the year, but not intraday. This intraday for the FANG is 28.84%. And of these FANG stocks, it represents about a little over, I took Netflix out, so let's say over 30% of NASDAQ futures, NASDAQ 100 futures. That's why it's taken off so strong. But it also is over 9 or 10% of the S&P index value as well. So that's what's given us this big boost in the month of January. Okay. Now, if we come down and we look at volatility, as I said, the VIX was just kind of moving up this week, moved back up into the lightly colored red zone over 20. Back, it's sitting right underneath the 50 EMA. All right. We've got a bullish chart here because the 50 is below the 200. So that would suggest the VIX has been coming down for quite some time, even though the markets have been moving down outside of October through now. So you can just see where we're sitting. And if I just take it back to when we hit the lows, these were the lows in October. These were down around 3,500. And you can see the markets did a swift move down, and then we're just back and forth. We haven't really gone anywhere in the VIX since December, early December. We came up, we slid down, and we moved back up. And the markets don't want to give up this bid. Now, this week, as I said, with CPI data hitting Tuesday morning before the markets open, and then PPI Thursday morning before the markets open, we're going to get some really interesting movement here. Okay. I think it's going to be real interesting to see which way this goes. It's either going to be a nice little move up or a nice little move down in both the VIX and the index, because if the markets indicate that inflation is sticky and not going away anytime soon, you're going to see the market start to price in a little bit more of a Fed aggressiveness in their rate hikes, and that's going to move the markets down. Like I said, our PE ratios, in my mind, are just a little bit higher than they should be. Okay. Now, if we come down here and look at Treasuries, if we look at the bond market, right, you can see interest rates are moving up. I had an initial target of the bonds up here at 136.18. You can see where the lows and the 2022 low, I mean, they're right here. It's just right on top of each other. We may come back down and test these lows and make new lows for 2023. Okay. I mean, we could see that happen very easily. And then that in turn would move the interest rates higher. You can see we came down and just, I thought the 200 would be our support element, and sure enough it is. And now we're up over the 50, and that is support. So I think we could come up and challenge this prior minor pivot right here around 3.89, right, in the 10-year notes. And then, of course, if we look at the currencies, dollar had a strong day on Friday, but you could see the dollar. It's just we've been short the dollar going all the way back here. Um, we've been short the dollar in most of Q4 into this year. You can see where it's now challenging the 50 EMA, right? This could be a potential area to pick up a short, but I would hold off until you see what the CPI is doing. It's barely in the red, but sitting on the 50 EMA underneath, trying to climb above. And we've got a bearish chart on the dollar that we had the cross right in the beginning of January, right? So, and we've been short the dollar since October of last year. And the best way to play that is with the euro. If we look at the euro currency, it's up. And you can see the euro, just like the dollar is testing the 50 underneath, the euro is testing the 50 above. If this holds up and starts to move higher, then it would be a nice time to pick up the dollar. Now I've got to adjust this. It's got new highs for this year, but only like maybe up a couple of percentage points. But the euro, our trade in the euro was way back over here, back in November, early November, and we've just been riding this thing really nice. It's been a good trade, and we got a bullish chart with the 50 over the 200, which is more of a buy the dip for the currency environment, right? And then, of course, if we come down here and look at gold, I've said all along gold is going to hit over 2,000. It's going to be an ugly play, but I said that we're probably going to have a dip, and you want to be a buyer of the dip here. You can see the 50 over the 200. It's testing the 50 EMA. Let's see where inflation goes in the CPI. If the Feds are going to be more hawkish, and they're going to keep the rates up higher for longer, gold is going to come down a little bit more. No one wants to hold gold when rates are going higher because you can make more money just holding treasury, short-term treasury, because gold pays no dividend nor interest. It's more of a hedge. And it'll put downward pressure on gold, because if we see that environment and the markets roll over, you're going to see the dollar get stronger too, which continues to put downward pressure on gold. I still believe it's going to hit 2,000 this year, but it's just going to and go over 2,000, but it's not going to be a smooth ride up like you saw right here. Okay. So that's gold. Silver's the same. Copper, if we get a soft recession, copper's going to come down. This is just a normal profit-taking move in copper. It's testing the 50 EMA. I believe if we get things settling down, a lot of this move here in copper starting in early January, this is all of January going into February, was when Japan, when China went away from their zero COVID policy. And they just put everybody in here because copper goes where China goes and vice versa. It's just, you see that China is a big industrialized construction in progress type of country. So they even warehouse copper. We don't, but they do. Like we warehouse strategic reserve in oil, they do the same thing in copper and other key metals and minerals, because they're such a big builder construction wise. So that's what this is. But I think it's going to probably settle down here and then give people an opportunity to buy that dip. Of course, if we look at oil, it jumped up on Friday. Where is it? Here we go. It jumped up nice on Friday because Russia came out and said they're going to cut production by about a half a million barrel, 500,000 barrels a day. You can see how it's coming up, but it's in this range here, right? We're just really going all the way back to December. It hadn't gone anywhere. It's just sine waving up and down, up and down, up and down. I think eventually oil is going to take out the January 23rd high, wasn't up that much, and move up towards the upper 80s and lower 90s towards the 200 EMA, right? And we've got trades for that, and our members are making money in it. So it's just one of those kind of trades that I think it's a low-hanging fruit trade that everybody needs to take. All right, everybody. Hopefully you got a lot of football fans out there. We got a really good Super Bowl kicking off tomorrow evening. Members, we will have our weekly market watch tomorrow evening, but I'll try and keep things pithy and short to the point so that we can all enjoy the Super Bowl. Have a great weekend, everybody. Members, I'll see you tomorrow evening. Ciao, folks.